So, if you've ever taken out a big loan, like for a car or a house, you obviously know you have to pay it back. But the way that actually happens, how that massive debt slowly but surely shrinks down to zero, that process has a name. It's called amortization. And believe me, understanding it can save you a ton of money. So let's break down how this all works. It's a question we've all asked, right? You send in that payment month after month, but what's really going on behind the scenes? How much of that cash is actually chipping away at what you borrowed versus how much is just, the cost of borrowing it? Well, that's the secret we're going to unlock today. And the answer to that question is amortization. Now, I know it sounds like a super complicated word, but the idea behind it is actually pretty simple. It's just the plan, the structured process that takes a huge, kind of scary loan and breaks it down into these small, predictable payments over time. Okay, so here's the most important thing to get. Every single payment you make is doing two jobs at the same time. Part of it is paying down your principal. That's the actual money you borrowed. And the other part, that pays the interest, which is basically the fee the bank charges you for letting you use their money. You can think of it like this little battle that's happening inside every monthly payment. In one corner, you've got the principal. That's your actual debt. And in the other corner, you have the interest, the cost of that debt. And who wins this fight? Well, that changes big time over the life of your loan. And here's the crazy part. In the beginning, interest is winning by a landslide. Because your loan balance is at its absolute highest, the chunk of your payment that goes to interest is huge. But as you slowly start chipping away at that principal, the whole balance of power starts to shift. So early on in your loan, your payment looks like this. It's super lopsided. As you can see, the vast majority of your money is going straight to the lender as interest. Only that tiny little sliver is actually knocking down what you owe. Honestly, it can feel like you're barely making a dent. But you gotta stick with it because after a while, you hit this amazing tipping point. Now, your payment is split much more evenly. You're finally paying off your debt at about the same rate as you're paying the interest. This is when you really start to feel like you're getting somewhere. And then, finally, near the end of the loan, the roles have completely flipped. Look at that. Almost your entire payment is now a direct hit to the principal. The interest is just a tiny little piece because your remaining balance is so small. This is the home stretch. So how can you actually see this whole thing play out for your own loan? Well, you don't have to guess. Lenders give you a roadmap, kind of like a secret schedule that makes this whole journey totally transparent. And that roadmap is called an amortization schedule. It's just a chart, a table, that shows you every single payment you're ever going to make. For each month, it tells you exactly how much is going to principal, how much is going to interest, and what your new lower balance is going to be. And right here, you can see the theory in action, month by month. Notice that total payment column, it stays exactly the same. But look closer. From payment 1 to payment 2, the interest drops just a little bit, and that same amount gets added to the principal. Now, it seems small, but over hundreds of payments, that tiny shift is what makes all the difference. Just let this number sink in for a second. On a typical $200,000 mortgage, a whopping $833 of your very first payment doesn't even touch your debt. It's pure interest. And that's exactly why understanding this schedule is so powerful. It shows you the true cost of borrowing, especially in those early years. Okay, so we've been looking at the month-to-month details. Let's zoom out and look at the big picture. How does all of this play out over, say, a really common long-term loan, like a 30-year mortgage? So let's set up a real-world example. Imagine you borrowed $200,000 at a 5% interest rate. Your mission is to pay it all back over 30 years. That means you're going to be making 360 payments of about $1,073 each. Let's see how that whole journey unfolds. This timeline really tells the whole story, doesn't it? For the first chunk of the loan, you're mostly just paying the bank for the privilege of borrowing their money. But then, right around year 15, you hit that critical tipping point we talked about. And from that moment on, every single payment is building your ownership, your equity, faster and faster, until finally, at year 30, you're free. The loan is gone. So now that you understand the system, you're probably asking the next logical question. Can you beat it? Can you speed this whole thing up and save a bunch of money? And the answer is a huge definite yes. This is where knowing the stuff really becomes your superpower. So how do you flip the script? How do you win that battle against interest way earlier in the game? Well, the answer is surprisingly simple, and it is incredibly powerful. The whole strategy comes down to making extra payments. See, any money you pay over your required monthly amount, it doesn't get split up. It's like a direct missile aimed straight at the principal. This lowers your balance, which then means you'll owe less interest on every single future payment. And the result? You can shave years off your loan and save thousands, sometimes tens of thousands of dollars. All right, let's do a super quick recap. We've learned that amortization is the system that turns huge debt into predictable payments. We know every one of those payments is a mix of interest and principal, and that this mix slowly shifts over to your side. And finally, we know that your amortization schedule is the map that shows you the entire road ahead. So here's the bottom line. Every loan comes with a pre-written story, a 15 or 30-year schedule that the bank laid out for you. But now, because you understand how it all works, you're the one holding the pen. So the only question left is, are you just going to follow their schedule, or are you going to take control and write your own much faster ending?